Have you ever wondered what really happens to your claims when you switch TPAs or stop loss carriers? Or why some employers still get stuck paying for old claims even after a renewal? Here's the thing, timing's everything in stop loss insurance. If you don't understand run in and run out liability, it could open yourself up to a costly gap in your protection. Today we're going to be breaking down exactly what these terms mean, how they tie into your contract, and how to keep your plan airtight, whether you're level funded or self-funded. Look, every claim has two key dates. That's when it's incurred and when it's paid, or when it happens and when the stop loss carrier makes the payment. And your stop loss contract decides which of these dates count. If you've seen terms like 12/12, 12/15, or 12/18, those define how long claims stay eligible. We did a full stop loss 101 video on these contract types that breaks down these terms in detail. Go check it out if you want the full walkthrough. For now, here's what matters. Once you change funding types or carriers, the timing rules can shift, and this is where run in and run out risk comes into play. When you renew or replace a stop loss policy, you have to look for timing gaps. Run in liability is old claims from your prior plan incurred before your new policy starts, but paid after it starts. Or run out liability is claims incurred during your current plan year, but paid after it ends. Fully insured employers never have to deal with this. The carrier owns those claims. But once you move to a self-funded or level-funded structure, you own the risk before and after these windows close. Here's a scenario for you. If you've been self-funded for years and on January 1st, you switch both your TPA and your stop loss carrier, an employee's surgery that happens on December 15th with the hospital not billing until February, well, this could open up some exposure. This claim was incurred in December, but paid in February. If your new stop loss policy only covers claims incurred after January 1st, then it's not going to be on your new stop loss policy. Without run-in protection, that claim falls in the gap and you pay it. Now let's flip it. If your plan year ends on December 31st, an employee gives birth on December 28th, but the claim hits in January, if your renewal's at 12/12, that claim's uncovered unless you added run out coverage like 12/15 or 12/18. This is one of the biggest oversights during transitions. Brokers chase cheaper premiums but forget about contract continuity. Here's the breakdown. If you're moving from a fully insured plan, you're clean. The carrier owns prior claims. Just make sure that your new self-funded contract starts on the correct date. If you're moving from a level funded plan, confirm the carrier's run-out period so that late-year claims don't get stranded in the middle. And if you're already self-funded, run-in protection matters most when you're switching TPAs or stop-loss carriers. And no matter what, protect the run-out tail on the back end. If you missed our stop-loss 101 videos on contract types or spec versus ag, go watch these next. They connect every piece of this puzzle. Here's your tactical checklist for run-in and run-out. Know your contract type. If it's 12/12, map your exposure. Negotiate transitional coverage. Ask if run-in applies to new plan years. Always protect your tail. Confirm run-out coverage before switching vendors. And last, track large claims early. Don't wait until renewal to reconcile these. This is risk financing. And in risk financing, precision equals protection. Your stop-loss contract is the backbone of this protection. Don't let timing clauses or vendor misalignment undo it. You can download our vendor evaluation worksheet and use our stop loss evaluation checklist from our benefit cost containment blueprint. These tools will help you identify hidden liabilities, evaluate vendors objectively, and structure a self-funded health plan built for long-term savings and stability.